Good morning, y'all. Gonna let
Good
some
morning.
folks.
Good morning.
Gonna let some folks in. We'll start here in just a few minutes. So next week's topic is about loans and credit. I know that one of the biggest needs consistently across this group is raising money, unlocking capital in some way. And before we get started, I just want to hear from you around what parts of that topic are you interested in diving into, so I can pull in more resources. For example, if I brought a bank in and they can kind of walk you through what they actually look for and how to help yourself get ready for a loan, things like that. Is that something that would be helpful to you?
Yep, I think that would be good. And if they require a business plan, if anyone has any information about that. I'm sorry, should we be typing this in? I apologize.
No, we're just having a chat.
Yeah. Okay.
I have a question about raising angel funding and the terms and like what's favorable for CPG. Yeah.
Okay.
Yeah.
I have a question about kind of getting capital in between rounds, or like what the best place to find more capital is if you're in between like fundraising rounds and without doing a down round or like making your business look less good.
Got it. Okay.
Yeah, maybe a talk track about how investors see debt. Like what just, as if you're planning to raise later, but maybe you need to finance via debt of some manner, whatever it is. In the meantime, like how does that impact the way they think about you?
Got it. And then a couple of other things. So tomorrow for Brew Crew, if you are a beauty brand in particular, I think you should definitely come to Brew Crew tomorrow. We are going to be talking to Tori Loss Phillips. She used to, she's done a ton of big CPG experience and has also advised so many beauty brands here. So she is a great resource for you all, and she is also extremely funny. She does improv and actually owns as a co-owner at Cold Town Theater. So definitely attend that. And then if you are looking to just stay connected and just continue to meet people in the community, tomorrow afternoon tomorrow's Friday. Yep. So tomorrow afternoon we have just a very casual happy hour at Central Machine Works, and Carbon Better is hosting us. So they're providing some beverages for that event. And then next week, if you're fundraising or you're going to be doing that soon, we have a state of fundraising call next Wednesday. So we're pulling in lots of people from different parts of the ecosystem to share some insights about what the last 6 months have looked like, and then also share some future gazing thoughts about what they expect will happen in the next 6 to 9 months to help our founders prepare. So just a few things coming up. And then our big event is May 3rd. It is our birthday bash. Some of you have also reached out already to figure out how to get your product and brand at that event. So if you have not done that yet, happy to, I'll send an email out for more info to get everyone, make sure that you have that opportunity. So now I'll be quiet and I'll turn it over to Justin. Hi, Justin.
Hi, everyone. How's it going? I just want to mention again, some of y'all were coming in, but Crystal's not going to be able to join us today, unfortunately. But we got a great presentation, and we'll kind of pick up where we left off last week. And I think, did we share out the presentation from last week yet, Katrina?
Not yet. I think Debbie's a little bit behind getting everything up on the platform, but it'll get up.
That's no problem. There were just some slides in that presentation that we didn't get to, so I'm going to start with those and actually spend most of the time on those probably here today. So if you see duplicated slides across presentations, that's why. So let's dive in here. Today we're going to talk about the financial statements. And again, we're not going to go deep on like accounting debits and credits. This is kind of meant to be sort of useful for y'all. Here's our contact information again. I'll show this slide again at the end, just in case you don't have it already. And yeah, let's dive right in. Oh, also I'll mention, since Crystal's not here, like please, as opposed to just sending stuff in the chat, questions in the chat, just interrupt me or talk over me, just get my attention some way, because I have trouble monitoring the chat and talking. So
I'll keep
please
an
jump
eye on
in.
the chat for you also.
Oh yeah, that helps. Thanks, Katrina. Okay, so this slide sort of speaks to why it's important to understand your financials. Your financials tell the story of your business and how your business is performing with actual numbers and data. So you can get in front of investors or anyone else and sort of say all the pretty things about why your product is good and great, but at the end of the day, they want to see some numbers to back all that up, right? So that's why, that's one reason why it's important to understand your financials. The other reason is it's important to understand, just for running your business and understanding how your business is performing yourself and where you're making money and where you're not. So those types of questions can be answered along with like what we've got here. So of course you can see your revenue and profit on your income statement. There are a number of different KPIs and metrics that you can track. Gross margin is one that gets thrown around the most in CPG, and we'll talk about that a little bit more here in a couple slides. And then understanding things like am I spending the right amounts? Am I spending money in the right places or in the right buckets? How are you doing against what you budgeted for, right? So it's important to understand where all those things are happening in your financials and how to read those. So the first, there are three primary financial statements: the income statement, the balance sheet, and the statement of cash flows. So we'll go over all three of those here and look at a couple of examples. The first and the one that most people are most familiar with is the income statement or statement of profit and loss, the P&L. This talks about what happened over a period of time. So what happened in the business over the course of a month, a quarter, or a year. And we're looking at things like revenue and sales, which is what left the warehouse or what you shipped for most of us here on this call, plus or less any discounts and allowances. And we've got this star here. This is not orders you've received from customers unless you've shipped them. So if you get a big PO from somebody in the last week of the month and you don't ship it till the next month, that's technically not revenue until the next month. Make sense? And then cost of sales is the cost of that product that you actually shipped in the month. And we'll talk a little bit more in detail about what's included in cost of sales or cost of goods sold. So when you take your revenue, deduct the cost of sales, that gives you your gross profit or your gross margin. This is the amount that is earned before your operating expenses. And it's really important, and like we see so much focus on it because it's really what is left to run your business after your sales. So the more profit, the more revenue, the more cash you have in order to run the rest of the business or pay for overhead costs. And then of course you got your operating expenses, which is everything from sales and marketing and just general rent and salaries and things. And then when you deduct those from your gross profit, you've got your income or your net income, or in a lot of cases at this stage, it'll be a net loss. Any questions on the income statement? No? Like I said, this is the one that like most people are most familiar with. It's pretty straightforward. And if I can just refer again back to last week, we're talking about accrual basis accounting here. So again, matching revenue and expenses with the period in which those were actually incurred. Okay, so let's look at a quick example here. High level, we've got our total revenue up here. This is in thousands, by the way. So we've got 95,000, pretty early stage, seed stage startup example here. COGS of 68, cost of goods sold, and we're deducting that from our revenue to get to gross profit. And this is our gross margin percentage here. We'll look at how that's calculated again in just a second. From there, we're reducing or deducting our expenses. We've got sales expenses like brokerage costs and maybe some travel there for the sales team. Marketing is like your advertising and all that fun stuff. And then operations is more kind of logistics, R&D, and admin or general and administrative expenses, where salaries mostly would fall at this stage, rent, and just kind of other expenses that don't fall into one of these buckets. Outside consultants would be in here. So you got your total expenses of 122, which leads us to our operating income or loss in this case of negative 95K. Make sense? Pretty easy, right? So let's on the next couple slides, we're going to dive in a little bit more detail, kind of up here, and look at what goes into total revenue and total COGS, because there can be often some questions around that. Okay, the first big topic is trade spend. This is a very basic slide for a big topic that goes really deep. Quick emoji poll. How many of y'all like know what trade spend is or have heard the term trade spend before? We got one. Madhu, Eugene. Okay, I won't go too deep into it. It is a very broad topic, and it's important to understand in the wholesale CPG space. I know a lot of y'all are probably still e-com focused right now, but in wholesale CPG we see it a lot. It does apply to e-com as well, because it goes in the same place. But basically, super high level trade spend is discounts or promotions that you're running on your product to drive volume. So anytime you're discounting your product, the cost of that discount is a reduction in revenue. So you can see here, I've kind of set it up. This is like a zoomed in look at our P&L here. So if we had 119K of gross revenue, we've got various discounts running in the month. There's a couple other things that fall under the heading of trade spend here that are included above the line as well as revenue accounts, but you can see they function as negatives, and we're reducing our gross revenue by the total trade spend number here of 24 to get to our total revenue. Does that make sense to everyone? This is important. Well, it's important to understand, and like we could do like a weekend retreat and talk about trade spend for 3 days if we wanted to, but I think it's really important just to get that stuff above the line in the proper place, like right below your gross revenue. The earlier you can do that, the earlier you're gonna get an understanding of what your true margins are, but also that's gonna, I think, earn a lot of credibility with any investors or banks that look at your financials and see that you're already accounting for these things properly. We see founders putting this stuff all over the place and everywhere but up here where it actually goes. So where does it go? The answer in 99% of the cases is above the line. It's a little bit reductive to say that and apply it to everything, but there are some exceptions. But in most cases, any discount that you're running on your product goes as a reduction of revenue on the P&L. Got it? So when we do that, so we've got our gross revenue is what you actually sold the product for. And then our total revenue, or you might hear it called net sales sometimes, which is our gross revenue less all that discounting activity. So gross revenue, net sales, that's all we need to understand here on this one.
I have a quick question.
Is that where you, oh, go ahead.
I use QuickBooks for my
Mhm.
P&L. Should I manually include this, or this is the automatic category in that software?
Yeah, you're going to want to set it up. So you would set it up as a revenue or an income account type. And I would organize it so that it comes after your product revenue, your gross revenue account.
Thank you.
And most of y'all could probably get away with just having like a single line on the P&L right now for this stuff. But as long as it's right up there in revenue, reducing your gross revenue is the key I want to get across here.
If you're gonna plan for some level of chargebacks, does that go under like allowance, or does that go somewhere else?
Well, it depends on the type of chargeback. So like, I'm trying not to go too deep in the weeds on trade spend, but trade spend more broadly applied can mean a number of things. I think technically when we say trade spend, that's like promotional activity or sometimes called working trade that is actually driving the cost of, or driving consumers to purchase your product. That's fairly easy to understand, and most people see that when you go see like a buy one get one free at the store, or 20% off, or $1 off. That's all trade spend. But there are a number of other types of costs and fees that you might incur that get treated the same way on the P&L. So I've got slotting and free fills here. That's the cost of getting on shelf at a retailer. And then returns and allowances is things like you might have things spoil at a retailer that they can charge you back for like a percentage of that.
Is it like RTVs?
Sometimes, yeah. And there are, you'll sometimes have a lot of distributors and retailers will require a discount for early payment on invoices. So usually that's 2% if they pay within 10 days. That's pretty standard. That would go up here as well.
Okay.
So things like that. The bulk of it is going to be discounting activity, hopefully. But early on, you'll see as you're expanding distribution in a major way, you'll see the slotting line be pretty heavy.
Okay. And do you know if there's like what the resources would be to go? Because I think more of my business planning kind of a 70-30 wholesale DTC. So more in the early days, at least, revenue is going to be driven from retail. And so do you know of any resources to dive deeper on trade spend?
Well, we're pretty knowledgeable about it. And Brittany, for you specifically, like you're playing in a space that's a little bit different than at least where our experience is. So we can talk about it more generally, and like most of what I'm talking about is going to apply directly to more directly to food and beverage, but you'll still see it in REI and all the like the outdoor retailers as well. It's just maybe a little bit different, or like the benchmarks are a little bit different in those different channels.
Okay. Yeah.
But we could, depending on how relevant it is for everyone, we could maybe, Katrina, like plan a separate presentation, like specifically about trade spend if everybody's into it and wants to go a little deeper on that. Like I said, there's a lot to it, and it could take up 3 days if we wanted to.
Hey, Justin, quick question. Eugene has a question in the chat. Are demo costs usually above the line or below the line?
Demo costs below the line. Good question. That is a marketing cost. So it's not actually tied to, a good way to think about it too is if the cost of it fluctuates with how many you sell or how much product you sell, then that's a good indicator that it goes above the line. But a demo cost, like you do that demo, you may sell 100 units, you may sell 10, but the demo cost is still the same.
I mean, just Justin, real quick, can you hear me?
Yep.
Okay, awesome. Yeah, I mean, I guess the way we think about demos is our demos result in a pretty, I mean, it's pretty predictable what we sell in stores, you know, especially as you think about it from the perspective of like, you know, maybe there's fluctuation in a day, but like generally speaking, we know that when we show up, we're gonna sell a certain amount of, you know, there's a range, and so in that sense, like one could argue that that is tied very much to, that's very variable, you know, to sales. But you know,
Maybe,
just,
but no, like maybe, yeah, I hear what you're saying, but it doesn't go above the line. Don't look for opportunities to put things above the line, y'all, because it is
no, I'm not. Yeah. I'm
is
glad
gonna
that it's
impact
not,
your margin.
you know, but I'm just trying to like, you know, rationalize it because like, you know, trade spends kind of similar in that sense, but okay, that's fine.
Yeah.
Cool,
Yeah, and we
thank-
can, like, if we need to, we can get into like the gap definition of like how to
yeah,
determine
no,
that. There's a couple
yeah.
of tests, and it's sometimes it's not as logical as you might think like that. But for the most part, just like err on the side of caution, put it above the line, except for demos, don't do that. But if you're getting a deduction and a payment from a customer, just 99% of the time those go above the line.
Yeah. Cool, thanks.
Okay. Okay, so that's trade spend. That gets us to our net sales or total revenue here of 95, right? Let's move on to cost of goods. I think this is fairly straightforward, though. There's a little bit of gray area in what should go in here and when and how to kind of get to that. But cost of goods is important to understand because it drives decisions around like how you're going to price your product to your customers, and what you want that price to ultimately be on the shelf at retailers, and of course impacts your margins. So the first few things are here, we have listed here as what goes into cost of goods. Are probably the most obvious ones: any raw materials, packagings, basically everything it takes to get your product ready to sell should be included in your cost of goods. A couple other things that you might not think of immediately are things like waste or yield loss or spoilage. Like if you've got products sitting around in the warehouse, even if it's finished goods, if you're not selling your product fast enough and it's spoiled in the warehouse, the cost of that product that you have to destroy or otherwise get rid of gets written off to cost of goods, unfortunately. Another one here, the last two here, I want to make the distinction between freight in and freight out. Freight in is bringing those raw materials and packaging and maybe finished goods from a co-packer to your warehouse. That's all freight in and should be included in the cost of the finished item. So yes, that goes in cost of goods. Some people break it out separately as a separate line item on the P&L, but where possible, I like to include that in the cost of the finished good itself. Now, freight out.
Is
I've
that
got
the
a question
same
mark
for
here.
a 3PL?
Is what the freight in?
Yeah, because I don't have like use a co-packer. It would be like from the factory to a 3PL to
Yeah.
and they would ship it. Is it the same thing?
To get it to the 3PL, everything before it gets to the 3PL is definitely COGS.
Okay, including the transportation costs from the manufacturer to the 3PL door?
Yes. Yeah.
Okay.
That's all freight in. And then freight out is where it gets a little bit debatable. Big food and beverage, big CPG companies all have freight out above the line. Technical GAAP definition is freight out goes above the line. But it allows for freight out to be reported below the line in operating expenses. And sorry, when I say above the line and below the line, I'm talking about above and below gross profit. GAAP does allow for freight out to be reported below the line in operating expenses if you footnote it in the financials. You guys don't have to worry about producing GAAP compliant financials right now in most cases, but the closer you can be to GAAP, the better. Again, the better off you're going to be in terms of interpreting your own financials for your own business growth, and also for raising capital. So,
Justin, one more question, and I think you're probably going to cover some of this as we go into fixed, but there's a question of rent, right? In particular, like facility rental, manufacturing facility versus like office rental. But like, I remember asking myself the question of like, and particularly when we were first starting out, and it was like commercial kitchens, like rental by the hour. Like, our argument there was like, we don't pay rent until we produce, and so therefore it's a cost of goods, right? Versus a below the line. And how do we think about that?
No, yeah, that's a great point too, Eugene, and something that I did not include here, but I think that's a little bit of an oversight on my part, just because most of the brands we work with are co-packed and not self-manufacturing. But in the case where you are self-manufacturing and have your own facility and team, but even if you don't have like your own facility, but like you're saying, you've got like a shared kitchen space, the cost of rent or ownership of that facility should be included in COGS as well. So it sounds like in the situation you described, Eugene, all of that cost would be in cost of goods. In the case where you've got maybe a building where part of it is office space and then part of it is manufacturing, maybe you've grown a little bit and got a little bit of scale and you've got your own sort of permanent or more permanent space. There are different ways to kind of divide that up, but most easily you can kind of think about it as a percentage of square footage in that space and allocate that piece of it to cost of goods.
But if we're in, so let's say Prep ATX, we have a dedicated space. We pay for that space no matter what, no matter how we produce. That should be treated as COGS. That facility should be treated as COGS.
Well, how are you using that space?
Just for production, really. I mean, they've got open spaces for office and so on, but we're not really using it as an office.
Yeah, I think I would actually, even though it is a fixed cost, I think that still goes in the cost of goods.
That goes in COGS.
Because it is used primarily for production.
For production, correct. Okay.
Yep.
Cool, thanks.
So we at Propeller at this stage, we put freight out below the line for most of our CPG clients, particularly those ones going into wholesale. Partially because GAAP allows us to do so, but also partially because it can create a lot of noise in your margin, because until you reach a certain scale, you're going to have a bunch of different routes to market. So UNFI may like pick up directly from you, but you may be shipping directly to KeHE or other retailers. And we finance and accounting folks like things to be smooth. And so that we can identify trends and kind of watch how things track over time. But if you've got these different, if you've got UNFI who's picking up at a lower price and we're not shipping it to them, we got them picking up a big order in 1 month, and we got KeHE picking up a big order the next month, and we're shipping it to them, and it costs a lot more. Your margins can kind of fluctuate wildly, particularly at this stage when you're still kind of growing. It's early, you don't have a lot of volume, like a big order like that can really spike things. So in an effort to smooth that out a little bit and get a better understanding of what our more kind of steady state margin is, we keep that below the line. Now, that having said that, you do want to keep track of it down there and keep track of it as in terms of your kind of total, your contribution margin, which includes all the variable costs, not just COGS and trade spend. Any questions on COGS? Oh, sorry. Before we leave freight out, I just want to say also, if your primary route to market is e-com, then in that case, we are putting freight above the line because it is more consistent and it is more directly variable to that revenue.
Just a quick one. What about commissions? If we had salespeople and commissions are given out?
That's a sales expense.
And
in operating expenses below the line.
okay, gotcha. Thank you.
Yep. So let's talk a little bit more about margin. This is, I promise, the most complicated and only math I think that is in this presentation. And I can flip back up to our income statement if we need to. But gross margin is your total revenue or net sales, right? We use those two interchangeably. That's your gross revenue less all of your trade or discounts. So total revenue minus COGS over total revenue. Any questions on that? Let me just flip back up here. So it's our total revenue minus COGS, gross profit, and then as a percentage, it's gross profit over the total revenue here. Got it? Easy enough? Quick emoji vote. Does that make sense?
Yeah, can you just go back to the slide really quick?
Yep.
Thanks.
Now, I mentioned I don't have a slide for this, and I don't want to get like too deep into different margins. This is definitely the most important one for y'all to know. But if you are going to put your freight out costs below the line, you want to, like I said, you want to make sure you're thinking about that as a variable cost and how it factors into your profitability when you sell an item. So there's also a margin called contribution margin, which is basically your gross margin less everything else below the line that is variable. In other words, when I say a variable expense is one that goes up and down depending on how much you sell in a given period. So if you're selling more in a period, your freight is going to go up, right? If you sell less, you have less freight. So the way to get to your contribution margin is start here, and then in the numerator, you're going to deduct everything else below gross margin that that is variable, like that freight out if you're putting it below the line, like those sales commissions Madhu just mentioned. Those are probably the two biggest ones that hit below the line. But if you're e-com and going direct to consumer through your own website, there are Shopify fees and merchant processor fees that get tracked below the line as well, that are variable and would be part of your total contribution margin. Got it?
Hey, Justin,
Okay.
One more question. Just on the D2C side, like if you've got a business that's got a D2C side as well as a sort of like more traditional brick and mortar distribution side, is there an argument to be made? Like, how do you treat marketing costs and advertising costs on D2C? Because that's obviously a pretty big part of like running D2C. Like, and you can argue that
Yeah.
like, that's, like how do you compare that? Because the D2C, if you put marketing costs below the line for D2C, specifically like online advertising, like you're gonna get
Yep.
a situation where the margins look fucking amazing. So excuse me my language. But the margins look great, right?
Yeah.
And then it's like the like how do you compare?
So that's another good question. The advertising costs, even though they are variable to a degree, are tracked below the line. They're not part of your cost of goods, but they do factor into that contribution margin, I would say. So like the strict gross margin definition that we've got here may look amazing for your e-com channels for most of y'all, as compared to like a retail channel. But by the time you factor in all of like the Amazon FBA fees and their marketing fees and everything else that is variable that hits below the line, more often than not, what I see is that contribution margin that factors all those variable costs in, that it tends to be pretty comparable sort of across channels. There are variances, but it's not quite like
Right.
the margin in the e-com channels isn't quite what it appears to be if you just look at gross margin.
Okay, thanks.
You bet.
All right, can you repeat where you said the Shopify, like merchant fees go?
Merchant
Like, can
fees
they go in
generally,
DNA?
yeah, that's where we see
Oh,
those.
okay.
Yep. All right. That's my last slide on the income statement. We're going to move on to the balance sheet, but any other questions on income statement before we do that? No? Okay. All right. We got like 20 minutes left here. So the balance sheet, I think folks generally have some understanding of it, but this is where it starts to get maybe a little bit more cloudy in terms of just general understanding. But the balance sheet, as opposed to the income statement, which is a report that reflects what happened over a period of time, a balance sheet reflects the value at a specific moment in time of the business. So all your assets and liability plus your equity. So actually we don't have it on here, but I will give you one more formula that's super simple. Your assets will always equal your liabilities plus your equity. And that's why we call it a balance sheet. You've got your assets and then your liabilities and equity, and the total of those should always match. And if you're using QuickBooks, it's hard to make it not match. So don't worry about like trying to get your balance sheet to tie like QuickBooks or other accounting software. It won't be, something's wrong with the software if it's not matching. But the key is making sure that the balance in each of those accounts on the balance sheet is correct. So let's talk a little bit more about those three categories. Assets are what the company owns. So you got cash, inventory, receivables from customers, any fixed assets, equipment. What else might be in there? Prepaids, if you're prepaying for any inventory, that would sit on an account in the assets. And all those things added together is your total assets. Then moving down to the liabilities is what the company owes at that point in time. So you've got payables, there's accrued expenses, there's any sales taxes, And y'all, if you are collecting sales tax, please make sure you're paying it. That's a big no-no. There are softwares and services that can help you figure that out. But if you're collecting it, you need to pay it. And then, of course, loans are liabilities as well. So if you've got an asset-based loan or a convertible note, that's going to be a liability on your balance sheet. And then finally, equity, which is money you or other investors have put into the business. Make sense? Okay, I'm going to move kind of quickly, pick up the pace here a little bit. We'll look at all three financial statements next to each other on one of the final slides here, because there's something I want to make sure to illustrate. But this is the same company balance sheet that we just looked at the P&L. You've got your assets up here, cash, AR, inventory, and fixed assets. And quick note, these appear on the balance sheet in the order of how liquid those assets are. So cash is, of course, the most liquid. AR follows that shortly, and then inventory you have to sell and turn it into AR before it turns into cash, and so on down the balance sheet. The important thing to note here on the balance sheet is we've got a note payable of $325K. This is how we funded the business this year. So we brought in $325K. It sits as a liability on the balance sheet. It went into cash initially, but we ended the year with $163K in cash. And our net loss was $96K. So where did the other, I don't know, what is it, $50K or so go? Well, it's right here, sitting in an AR and inventory. And we'll see that better illustrated on the cash flow here in a second. Any questions on this? Okay. All right, statement of cash flow is where I start to lose people. And this took me a while to get myself, if I'm being honest. But now we're back to a report that shows us what happened over a period of time. But this is actually how the cash moved within the business, within that month or quarter or year that we're looking at. So it always starts with the beginning cash, and then we've got, it's a measure of the change in assets and liabilities on the balance sheet. So we've got, if our inventory amount increases over that month, that means we paid for inventory that month, or we brought more inventory in. So cash had to go out to pay for that inventory. So the difference between the ending balance and the starting balance is how much cash we paid for inventory. Does that make sense? Just high level? We'll see it again here when we look at all three of them together. And then it kind of functions the opposite for liabilities. If our accounts payable amount goes down over the course of that period, that means we collected that much cash in the period. So that's cash in. And then, of course, so you got change in assets and liabilities, and then any financing that you may have received in the period. So money in from investors usually, or fixed asset purchases. Got it? Okay. There's the cash flow by itself, but let's skip over that and just look at all three of them next to each other. So here's the same income statement we just looked at, and the balance sheet and the cash flow. The income statement, again, we had a net loss of $96K for the period. You might think, or you might assume that, okay, well, that's how much we lost in the period, so that's how much cash we needed to get through the year. But we actually, if you look at our statement of cash flow, we actually had $157K in cash go out the door, because we had an increase in our receivables of $32K and an increase of our inventory of $60K. Now that's offset a little bit by our increase in AP down here of 30K. So roughly 60K is eaten up by working capital. And working capital is something that we haven't talked about here yet. But working capital is your current assets plus current liabilities or less current liabilities. And you can see that's the biggest drivers of that are your receivables, inventory, and AP. So the important thing to note here, or that I want you guys to take away from this, is that the cash you need to run the business in a given amount of time or in a given year is not equal to your net loss for the year. You got that? So here we're only talking about 60K, and that's a lot. But if you kind of extrapolate this out to a year or two in the future, when the business is doing $2 or $3 million in revenue, and you may increase your inventory and receivable by like 500 or 600K or more in some cases, that might be 500 or 600K more than what you're actually losing in the period. So when you're thinking about raising capital and how much capital you need to run the business, always take into account your growth in working capital or your growth in inventory and accounts receivables. Any questions on that? No? Really? Bindu?
I mean, I don't have questions since I have accounting background, but I think I can see why for a lot of folks the cash flow just looks crazy. I would just say, just to see it from a general perspective, like you're putting in your balance sheet items into the cash flow, where your income statement doesn't report that. So that way it's not so confusing to understand it from the beginning perspective, but it's really hard to understand cash flow. I mean, even as an accountant, we were struggling. Even in grad school, we're struggling. So I would say for a lot of folks, just don't be too hard on yourself if you don't understand it. It's even for accountants ourselves, it's a pretty difficult thing, and it takes a while. So
yeah, and don't worry. I would say too, don't worry about like having to put a cash flow together, at least when you're looking at historicals. This is largely an output of what's happening on the balance sheet primarily, and then of course the net income factors in right here. But it's largely an output of what's happening on the balance sheet. So it's all formula driven and calculated. But again, just to say it one more time, sorry to sound like a broken record, but your net loss for the year, your forecasted net loss is not equivalent to the cash that you need to run the business in that period. Okay, well, if anybody, so we'll share this deck with y'all. If anybody has questions or wants to go deeper on the cash flow or anything else, let me know, and I'm happy to jump on a call and address specific questions. But thanks for sharing, Bindu, and definitely don't be embarrassed about not understanding the cash flow. It took, like I said, it took me a while to get it also, but once it clicks, it's a very powerful report to help you understand kind of where the cash is going in a given period. This slide I love. So what we're looking at here is just kind of on the left here, we got a couple charts. So on the left, we've got a chart looking at sort of different stages of business, right? Or different stages of revenue for the same business. So kind of as you grow, this is what a growth curve might look like in terms of revenue. And then here you can see our margin in those same periods. Now this would be a great scenario, and everyone's mileage will vary, but you can see, I think the thing to take away from this is that the margin should go up over time. Nobody expects you to have like amazing 60% margins out of the gate, or even 50%. Whatever they are right now, we would hope to see them improve over time. as a business grows and gets scale. So there's a lot of cost reduction that comes at scale, of course, and looking for those efficiencies and being able to talk about when you might realize those efficiencies is going to help you in those investor conversations. This other chart over here is great, I think, because it sort of lets you see or gives you insight into kind of where that spend might be as a percentage, or where it could or should be. But don't take this as gospel. And I think we're all down here in this sort of seed stage, maybe you're in launch stage, but in one of these first two columns. And again, this is kind of going up through those different stages, roughly along these revenue targets here. But you can see as a percentage of your, this is a percentage of your gross revenue. As a percentage of your revenue, these different expense buckets are much bigger down here in the early stages. And then over time, as you increase scale, increase your volumes, you're getting more and more efficient in each of these buckets. Does that make sense to everyone? And so I would use this as like just a general sort of guideline to help yourself understand sort of, or compare to like where you are or where you think you are against these percentages at like an early stage. You good with that? All right, just time check. Any questions? Should we pause here and open it up to Q&A for the rest of the time, or I've got a couple more slides we can go through if there are no big questions.
I think if you all are not, if in this setting, if you're not necessarily comfortable talking about your financials in this group, Dustin and I were talking about potentially putting together office hours so that you can get one-on-one time with the Propeller team. So that's we're working on that. But can you all give us a thumbs up if that's something that you want to do, so that I can get a sense for, if that's valuable to this group? Okay, that's thumbs up there. All right, thank you.
Okay, so I've got a couple more slides here. So let's look at these. This again, I think is helpful to look at and sort of gauge where you are relative to like the relative stage that your company is in. In the beginning, we've got sort of low revenue and a profit even lower, right? And you're focused sort of on these things down here. Your team, just kind of setting things up, getting that corporate structure in place, getting your MVP, and still doing a lot of R&D and making sure that you've got a product market fit, and then raising some seed capital. And then the next stage is sort of that high growth sort of rocket ship phase. Again, notice that we've got team here as a first billet across all of these stages. But here in the growth stage, you're like increasing customers, expanding into new markets, expanding that distribution, maybe starting to think about new product lines or additional SKUs within your current product line, and then raising growth equity, which usually comes in the form of VC investment or maybe private equity investment. And then later on down the line, things are shifting a little bit more. That revenue growth is starting to flatten out a little bit, but we're still seeing profitability increase. And this is where we're really kind of starting to think about an exit and optimizing all those metrics like gross margin, and kind of setting the business up for an eventual sale. This one we looked at last week, so I won't spend a ton of time here. But I wanted to include it again, just because as we're talking about expectations at different stages of the business, just wanted to show that again. But again, here in the very early stages, you're just kind of getting systems and things in place. And then when you raise that Series A, that's really when you take the first big leap in kind of financial sophistication. Okay, this is sort of starting to get outside the scope of accounting a little bit, but I like this slide a lot. And I know you guys are going to talk about funding or different types of fundraising here next week or in the next couple of weeks. But in terms of just sources of capital, this sort of shows a number of different common types of capital sort of arranged by their relative cost. So accounts payable is your best friend. The more terms you can get, more and better terms you can get from vendors, especially your inventory suppliers, if you can get on 30 or even 60-day terms with them, that just gives you that much more time to produce your product and get it into the market and potentially collect on it before you actually have to pay for it. So that usually is free. Moving down, secured bank debt is usually not an option at this stage. Most banks will want to see companies have profit before they will lend to them, but they're lending kind of in the single digits interest rates, which is great if you can get it. Then beyond that, you've got unsecured debt from commercial banks or venture banks, other non-bank lenders, which we'll see do a lot of, I think I mentioned briefly, asset-based lending earlier. So a lot of our clients in the earlier stages that are not eligible for this bank debt will go to get an asset-based line of credit, which somebody was asking about options for in-between financing rounds, which is one we leverage a lot with our clients. So that's lending against your accounts receivable and inventory in some cases. So if you've got 500K of receivables and 100K of inventory sitting on the balance sheet, that's cash that's tied up that you can't move or that you can't use to run the business. So those asset-based lenders will come in and lend against a percentage of that and maybe free up 300 or 400K for a price, of course. But that's a great option to kind of extend runway between those fundraisers. And then of course, equity is the most expensive, almost always, with preferred equity being the most expensive, even though you're not paying for it. You don't pay that cost immediately, but at exit, that's when the equity gets paid. What else do we have? Yeah, I think that's a good place to stop. I got a couple other things. Oh, I do have some more math in here. Sorry, I lied about that. There's some other ratios down here. We don't have time to get into them, but there's some basic formulas there and super high overview of what those ratios tell you here in the appendix of the presentation. There we go. We'll end it right there. Any questions? I do have, I know we're bumping up against 11 o'clock, but I've got a little flexibility if anybody wants to stay on and chat more.
Questions, y'all? I know this is, these topics are dense, right? And kind of seeing them is a lot and you need some time to digest. So I think we'll work on those office hours for you all. Justin, if someone is going to sign up for office hours with your team, what should they bring to help them get ready for the conversation?
Any financial statements that they have currently, like current financial statements, and any forecast that they might have would be helpful too.
Awesome. Since we're at 11, just a couple of announcements before we close out. So May 6th, originally we were going to do an in-person Brew Crew social, and since we are hosting our our birthday party on May 3rd, which is going to be one of the biggest industry events regionally that we've had really since 2019 before the pandemic. I encourage everyone to attend that so that you are plugging in and connecting into the community. There'll be hundreds of people there, and it'll be a really fun event. That's May 3rd from 6 to 9 p.m. at Fair Market. And what's coming up, I think that I've received a few emails from folks about topics. So if you have any specific needs, I mean, you all have definitely filled out your acceptance form with some of the things that you all are working on, but with the upcoming topics that are coming up, or if you are have more questions, about financial literacy. I mean, Justin and his team have been so generous with their time and are sharing their contact information. So please make use of the resources that you have. And let's say you know more than some folks in this room. Please share your experience about how you helped yourself learn some of these concepts or resources that you may have. I think this is, everyone here is coming at a different stage and we're all going to know different things. And sometimes we may think that we also know something that turns out we may not know very well, or turns out we know something better than we thought, which is a confidence booster, right? So I know that we're kind of experiencing these learnings together. So be open and share also resources that you have come across. So I appreciate this group for being open during this time. And then I think there's a couple of people that have been paired with Super Coffee. Jamie, she is just coming back from vacation, so bear with her as she is getting back to you on that. So Jamie from Super Coffee is the point of contact, and you'll have access to the Super Coffee team. So that's how that particular relationship will work. And then there's a couple of pairings we've had to shift around. Two of our mentors had to leave the program for either a family emergency or they moved to a different role. So we are hustling up and repairing a couple of books. I think that's really only affecting maybe 2 people. So if you have not received your advisor pairing, can you please reach out to me to make sure that we've done that for you. We went through the list for everyone a couple of days ago. So just in case we missed anyone, please reach out to me. Awesome.
Thanks, Katrina. I had a quick question. Did you say that we should follow up with you individually for the birthday, or are you going to send something separate for everybody?
I'll send something separate to everyone.
Oh, okay.
And then if you're not in Slack, we're doing announcements in there as well. So make sure you're checking that.
Katrina, quick one. Other than the mentor that you're paired with, if we're interested in, let's say, connecting with another additional mentor, is that a possibility? Not like for a full-on, throughout the course, just like being able to reach out and
yeah, there's a few of those folks that we're putting together right now, ideally, and there's also some latecomers that are coming into the program. So you'll get additional pairings, but we wanted to make sure that out of the gate you had your one. So I think, Madhu, if you have specific needs, feel free to message me on Slack and tell me a little bit more.
Yeah, awesome, thank you.
Some of these advisors are, I think, especially the ones that are very busy but could be really valuable to this group, will probably create more of a one-to-many interaction so that it's more of an open conversation, so that they can do more of a group mentoring, and we could schedule opportunities for folks to hop onto those conversations.
Yeah. Awesome, thank you.
Okay, well, thanks for your time, Justin. Appreciate you.
You bet. Thanks, y'all.
Have a great day, everyone.
Thanks, Justin.
Thank you, everyone.
you.
Bye.
Thank you.